He's like a butterfly flapping his wings deep down into the forest, man. It's gonna cause a tree fall like 5,000 miles away, man. There ain't nobody seeing nobody. Man, see, like, you don't even know, man. It's like you're born into this world, man. And you got like that, man, the dust and wind, man. Or like the dang old candle, man. It don't matter, man. It's all the time.
You know, Stormy, it is actually quite difficult to record with you. Not necessarily because of, scheduling or, we don't have anything interesting to say. But because I swear every time we do this, we end up talking for like half an hour before we even get rolling about just completely unrelated things like goy beams and and literary release schedules and all that. But dude,
Rods
it's
from
great to have you on,
God,
man.
goy
Yeah, yeah.
beams.
all
Oh
true.
man, it's all true. It's good to be back. I wish one of these times I'm gonna have to come on and talk about something positive, but today's not going to be that day.
Yeah, today is most certainly not that day. So we're going to talk about a couple things. Inflation, for one, but more generally, kind of the all of the compounding issues from basically the Federal Reserve and setting interest rates, right?
Mm-hmm.
There's a really interesting discussion to be had about Canada that, we can get into in a little bit. But I think it's important to talk about this because if you've really heard anyone talk about this who's outside of the band of normal people, right, who depend on something other than assets for their daily living expenses, it's sort of hard to bridge that gulf. Because what really prompted this discussion was a comment, when you and I were going back and forth about this, where I just asked an open question of how much of the growth in the market since '08 plus or minus is actually due to the market growing and how much of it is just inflation. Because in that conversation, we were talking about the fact that really we've been in a recession of some type pretty much off and on ever since then. We never really recovered. And I saw this happen in real time as I finished up college, where the Biden admin just changed the definition of what a recession was, so we magically weren't in a recession. Right? It's magic words, theory of economic analysis. But once I did some digging, and people will know this isn't the most esoteric knowledge, I realized that, well, that exact same thing happens to inflation, right? The way that it is measured is completely and totally contrived. So that was really the genesis of this conversation. And yeah, man, I'll kick it to you, Stormy.
All right. So, like, if we take the S&P Composite Index, I have it up somewhere here. All right. The real return. So let's just say, I think that what is the let me see what the overall adjusted or what the we'll say the S&P 100 annual return for 2025. All right, it was 9.3% by year end. All right, so that's not great. But what's the actual rate of inflation? Well, I can tell you it's not 2%. You probably already know it's not 2%. Right? So actual inflation, see, all right, this is funny. You know how you just said like the Biden admin changed the definition of what a recession was? And we thought that was really funny. Everyone online joked about it. But what everyone didn't know, or maybe knew a long time ago and forgot, the Federal Reserve has changed the rate at which it calculates inflation 3 or 4 times now since you've been born. So basically, when something is inconvenient, they just stop calculating it. So in 1980, we used to factor things like housing costs, energy costs, healthcare into our inflation metric, our CPI. And then in 1990, we threw out two of those things. And in 2000, we threw out even more things. So now, when we calculate inflation, the cost of housing is not included. The cost of houses, not included. The cost of energy, not included. The cost of healthcare, not included. And they'll probably throw out groceries too. So maybe they'll just calculate inflation on, the cost of streaming services. I don't fucking know. So if we were to calculate inflation on what inflation used to be calculated on, right, the 1980 methodology is probably the most honest we've ever been. And if I look at that, same inputs, just calculated the way we used to. 2023 was 15%, 16% inflation. 2024 was 12, 13% inflation. Right? It was at a steady 10% a year from 1993 to 2019. So if you had $1,000, let's say, in 2020, right? So something cost $1,000. That thing from 2020 to 2026 is now $1,900, right? Which is a actual rate of inflation of, because these are lagging indicators, so I had to do it forward, right? So about 15% a year has been the actual rate of inflation since 2020 to now. And that compounds like compound interest. This is the thing that boomers don't understand about inflation. Well, boomers were lied to about everything. So when they see on the news that, inflation is coming down, right? It's down, down 1%. Inflation's coming down. That'd be like saying you have a 15% interest mortgage, and for 1 year, I charged you 14%. That's basically what it's saying. Inflation compounds just like interest, and the cumulative effects are kind of what boomers can't see. So when you talk about stock market returns, right, you can adjust them downwards for the inflation each year, but that doesn't really factor in the cumulative inflation you've already got in there. So actual stock market returns, right, for the last, I don't know, S&P 500 has ranged somewhere in between 10 to 17%. And now let's minus 12% out of that conservatively. And then you're looking at your real rate of return. So all this big stock market bubbles, Trump is talking about how the S&P 500 is going to be at new highs. It's not. We're at 0% actual returns, maybe 2% returns, 3% returns, the highest. So that means if you were to, let's say you're investing, you now need to, if you did 25% returns that year, you would be very, very happy. But you didn't actually do 25%. You did a little bit more than 10. So in order for you to keep up, you have to earn 15 to 20% just to tread water. And no one's earning 15, 20% a year. So even boomers with their stock market returns, those are all fake. Right? It's just happening slowly to where they don't notice. They see their 401k going up and the value of their house going up, but they don't compare that to the purchasing power. Right? So like, let's say you're a boomer whose house doubled from 2022 to 2024, which most of them did. Well, the cost of everything doubled. Right? That $1,000 thing now costs $1,900. So even the boomers who are so scared about their housing costs, like their value of their house, they don't know that the value of their house hasn't increased at all. It's actually gone down. So inflation is so ubiquitous. It's kind of baked into everything that people don't notice it, right? Or they don't notice to look at all aspects of their life, right? So they see their stock market returns as separate from what happens to the value of the dollar. They see their house, price as separate. And they're really all a function of the same thing, right? The boomers really haven't made all that much money in real terms at all. So it makes the situation that the younger generation is put in significantly more damning. Because if you say, all right, boomer, you really actually haven't made that much money. All the money that you think you made has actually just been currency debasement. Okay. Well, then what does that make the youngest generation whose, quality of life has now, been admitted by everyone as going to be exponentially worse? Right? Everyone thinks the boomers had it so much better. They did in certain aspects, but not since 1980. They haven't. And most of the boomer gains that we look at as gains happened after 1980. They've just been they've basically been cheering on currency debasement, thinking they've been getting a pay raise. All of the cheap stuff that we talk about, like, oh, you were able to buy a house at this price, a single family could, be sustained off of one guy working a factory job. Not in 1980, and certainly not since. So the time that people are really attributing to, livable time was when the boomers were kids, right? Like teenagers, early 20s, shit like that. But what's going to happen now, and this is what I kind of wanted to talk about, is velocity of money. And no one really talks about velocity of money. And velocity of money is probably just as important. So when you ask a libertarian about inflation, he'll talk to you about the Federal Reserve and say a bunch of dumb shit he doesn't understand, which is why Peter Schiff is always wrong. Right? He has no idea even now why the price of gold is going up, because he's a fucking retard. Sorry, I shouldn't swear so much. But libertarians aren't factoring in velocity of money. Right? They'll tell you how much money was printed, and if you print this much money, of course, this is, inflation's gonna happen. Like, inflation happens much, much more from velocity of money. So the Trump government is going to try to tamp down inflation, even though he thinks he's going to be able to run it hot, just like he probably thought he could do everything for Israel and win domestic politics. He's quickly finding out that's actually not the case. The admin is going to be forced to choose yet again. And by the person that he picked, all right, everyone is like kind of obsessed and like, oh, this guy is the son-in-law of the head of the World Zionist Council. Like, yes, this is also true. But he's a really big hawk as far as Fed policy. So that means they're going to try and tamp down inflation. And they're going to do that with the only tool that they have, which is the interest rate, which generally works kind of, right? If I raise the interest rate, people borrow less money and they hold loans for less amount of time. And most of our money, right, most of the printing doesn't happen at the Federal Reserve. This is again why libertarians are fucking wrong about everything. All of the money printing happens in the banks because they're supposed to do that, right? So the Federal Reserve sells them treasury bonds at a certain rate. And then they take those treasury bonds and put them in their bank vaults, call them reserves, and they will lend against them, right? Usually like 10 to 1. And it's the lending that they do, the issuing of mortgages, things like that, that actually prints the money, right? The money is printed by loans created off of those treasuries. The money isn't printed by the creation of treasuries.
Well, and Stormy, as I'm sure you're aware, during COVID, and it might still be the case, I haven't checked, the reserve rate was dropped to 0.
Yes, I was going to get to that.
Even further ridiculously increasing the amount of effective inflation.
Yes. And then also this other thing happened, which are called non-bank lenders. Right? And this is a new phenomenon. Like all of those like buy now, pay later apps that you've seen just explode everywhere. Those are lenders. They're printing money. Right? Like you're,
well, I mean,
Uber Eats,
let alone
payment
right,
app.
the explosion of digital consumer loans.
Yeah, that's what I was
Klarna, any one of these other kind of knockoffs.
And also the sports betting. People don't see sports betting as inflationary, and it very much is. Right? Because when someone is, placing a bet at like 10 to 1 odds, right? That's leverage. Because if you win, you expect to be paid that 10 to 1, don't you? Right? It's no different than leverage. So the explosion of derivatives is another type of, again, lending. Right? This is where the inflation actually comes from. That and velocity. So this new man is going to raise the interest rates very sharply. I mean sharply. I don't think I don't think people give credit where credit is due to Jerome Powell. Jerome Powell is a saint. The world economy existed on basically 0% interest rates. The US had a negative interest rate for like 10 years, right? Because if the interest rate is 2%, but inflation is like a lot more than 2%, that means the interest rate is effectively negative. So the US has had negative interest rates for a very long time, which again created the explosion in lending, which is the explosion in the monetary supply, which is why boomers think that they were getting rich, but were actually just treading water themselves. They're easily fooled, those boomers. But he raised the interest rates from effectively negative interest rates to 5% during a fucking pandemic, all without a market crash. Like, credit where credit is due. Jerome Powell knows how to do his fucking job. And this guy is probably going to be as aggressive, if not more aggressive. So what happens when interest rates go up? People borrow less money. Right? So that's how they're going to bring down inflation. Because don't get me wrong, Jerome Powell, over the course of raising those interest rates, he basically zapped $5 trillion with a goy beam and disintegrated it. Right? $5 trillion disappeared by him raising interest rates. That's going to happen this time. Except what's also going to happen is the velocity of money is going to tank. We're already seeing it now. Every single person listening to this is probably agonizing over each and every expense that they have to make. And that means people are scared to spend money. And when people are desperate to save money and to spend as little as possible, the velocity of money goes down. And then inflation goes up rapidly. Right? So if velocity of money is high and money is changing hands and moving all around, its inflationary value is effectively zero. But if everyone yanks all the money out of the system, right, and tries to stuff it away, and there's less money going around, counterintuitively, it makes things more expensive. It's just it's just a demand side problem instead of a supply side problem. So they're going to create a demand side problem at the time when they go about trying to solve the supply side problem. And unfortunately, they're using the one lever that is in their control to solve a problem and then create a problem that is in a domain where they do not have control, because velocity of money is entirely psychological and macro effects based, right? So like I say macro effects because if you are, trying to agonize over all of your spending, trying to spend as little money as possible, you are reducing the amount of velocity of money. But if I also ship your job to India, I've effectively done the same thing.
Well,
right?
and
I've pulled your whole salary out of the money supply. I have decreased the velocity of money by however much you used to make.
well, and to that point, look, I was never a highly compensated employee, right, in the grand scheme of things. But
incredibly undervalued.
thank you. That's a nice way to say perpetually unemployed. But what you would have is that jobs like that would have been a way to outpace, or at the very least keep pace with inflation. Relatively high compensation, taxed advantaged ways to dump that money into the market. Right? We don't need to get into that. That's a discussion for another day. And now obviously that's quite expensive for the firm, which is why they are, they are offloading. But a problem which historically has been reserved for the working class and for young people, it's coming for your laptop job, right? You can't, not everyone, I'm sure someone will, but the ability to out earn this is sort of going away. And
yes.
Unless you already have assets, because again, when, monetary velocity goes down, if you're a seller, you have to deeply, deeply discount whatever you're selling, because people are, generally it's like, well, I don't want to be giving up money, but this is such a good deal, I can't say no to it. Well, even people who do have assets, well, sure, they have an asset. That's good. They own that thing. But if they don't have the income to service that, to make their mortgage payment, they're going to get blown out of the water, because the market for most things is going to crash. And there are leading indicators of this, right?
Yep.
Buying in, assets like cars is way, way down. Cars have been hit by inflation like crazy.
This is actually the perfect example. I'm glad you hit this. This is
Yeah,
the perfect
both on
example of how demand can collapse, but prices can still increase.
exactly. Because, demand for new cars is, way down. You've been reading stories about this really since around 22, 23, but it sort of continued apace. But one, well, the interest rate's up, so your cost of lending is proportionally quite high. But also, people are unlikely to dump something for more of a loss than they're comfortable with. So you just have, in general, incredibly low velocity of both money and of assets.
Mm-hmm. Bingo. This is why. Housing is another thing I think we should talk about, because so I think I made a prediction a long time ago on maybe this show or others, right? That the demand for housing was going to collapse, just from demography and overall, prevailing financial conditions. And I think we've seen a pullback in every major housing market in the country, and things still aren't selling, right? Like literally nothing is selling. All of the boom states, right? Colorado, Texas, Florida, are now the lowest transaction volume states in the country. The amount of real estate transactions that have happened this year are half of what they were the year prior, right? So 50% of demand just disappeared. And that's going to steadily increase. And the prices with those are going to go down briefly. And then the thing that Jay and I are talking about is going to go up, right? So you're going to basically shake a bunch of people out of assets, and then those prices of those assets are going to balloon. If you didn't want to set up a permanent underclass and you just happened to do it by accident, I don't think you could have come up with a better way of going about it. You really can't, because the boomers, you're going to see a lot of properties literally rotting away because the boomers that lived in them died, and their kids can't sell it because no one wants to buy it. And then no one can afford to buy it to move in it. Right? So you're going to have a housing problem at the same, like you're going to have a housing problem as in like cost of housing at the same time as you're going to have basically a ton of inventory empty everywhere, which you're starting to see now. So there's very few things that administratively can fix this without really like a total crash out. And I don't think that's what people are bracketing for.
Well, and this is a point that Mark Mitchell of Rasmussen, who was on my show not too long ago, made.
Great episode.
Oh, thank you. He made a really interesting post to Twitter. It was today or yesterday, relatively recently, where he basically was talking about a recent meeting he'd had with the president, where he said, I went in there and I said, Mr. President, you need to crash the housing market.
Mm-hmm.
That's an option. And he was basically saying, he's like, yeah, and I could tell no one had ever told him that before. And you see that in the messaging from the administration, right? He said, I will do nothing that allows the value of housing to decrease.
Well,
so we're not
foreclosures are now hitting the full time. The foreclosures are now coming close in commercial real estate, right? This is like,
commercial real estate's been screwed for 6 years.
Yes, but so has our housing market.
Well, and that's my point, right? That, you could look at the situation in not corporate. Point is, kind of like business and real estate in 2020 and say, this is never coming back. This is screwed. But it's taken more than half a decade for that to actually shake out. And yeah, sure, on a long enough time span, you can simply say, well, I'll stack cash and wait for the market, the bottom to fall out of the market. But you need a place to live. And let's also acknowledge that, that these same trends are hitting rent because someone is paying a mortgage on your apartment, right? Mm-hmm. Someone is being forced to bear the higher cost of interest. And
also, what are you going to put that money into? You can say gold. Like, okay. Everyone that says gold, are you going to stuff your money in gold, has never tried to liquidate gold, right? Have never tried to buy anything with it. Because when you go to buy something with gold, when you turn your gold into money again so you can make your purchase, you will be surprised to find out that no one's going to buy it at whatever the spot price of gold is. Right? You will take a 10 to 20% haircut. You can just go to Kitco and find out what the wholesale rates are for buying. And that's basically a global exchange or a national exchange. And you'd be like, wow. So basically I buy a thing for this price and no one will buy it for me. No one will buy it for me quickly for the same price. Well, that's bullshit. Yes, it is. Yes, it is bullshit. Right? Because when you're the seller, you either have two options. You could either just run around and ask everyone you know to come buy a piece of bullion off you, the guy, when they could just buy it from like a place that actually sells gold. Like, so just, do you trust the stranger on Craigslist? No, you just buy it from the people that sell gold. Or you try and or you're forced to sell it to them. And they're not buying it back for full fare. So all of the people that say like, oh, well, I'm just going to keep all my money in gold. Well, great. Try and turn that into money when you need to buy a house. Tell me how much money you saved.
I mean, let alone the storage and transport issues, right?
Yeah.
I actually do know someone who bought a piece of land with a, quote, Suzuki's Jimmy worth of silver bullion. But, one, it was the 70s. And two, it's in Baltimore. You really want to go to Baltimore to pick that up?
Try driving through Baltimore now with a Suzuki Samurai full of silver dollars.
Well, he did describe remembering his dad with an open bolt transferable Uzi. So
I guess
that's how you
cool,
do it.
Then.
Yeah, it's a pretty cool story. But
nonetheless, so if you can do this, if a person is in the position to drive a Suzuki Samurai full of silver bullion at the same time as, wielding or having holstered an open bolt, fully automatic Uzi and drive through the hood of Baltimore. If anyone is able to do this, you are like duty bound to do this.
Well, and also like, if you're that cool, what are you taking advice from us for? Right? Yeah, you've obviously got other plans. But yeah,
land is actually a good thing. Land is better than gold.
So one other thing, Stormy, one of the things that you talked about when you and I were on the phone is that this problem is not unique to America. Well, I mean, it is in the sense that we're the ones making this decision. But, as you said, right, the Fed coughs, the world catches a cold. Mm-hmm. And specifically, you were talking about the nation of Canada, which I'll be honest, man, I am sort of equal parts disturbed and amazed by the nation of Canada. Nothing to do with you Canadians listening, you're great, particularly if you give me money. But maybe we could examine that as one example of how this causes issues for other people than just kind of normal working Americans.
And Canada is actually a very good case study of how this could shake out, right? Which obviously isn't great. So Canadians have a couple problems. So one, well, you guys have lots of problems, but let's just take the Canadian real estate market, right? So Canada basically exported all of its production capacity, right? The ability to make things, right? The regulators have made it impossible to, start up a thing to make things. Agriculture is basically regulated all to hell. Energy is regulated all to hell. And it doesn't really make a lot of money, just as a nation. So I'm going to come back to that in a second. And that's going to be important. So Canada has had a real estate boom bigger than ours, right? So as much as people are upset about what's happened to US real estate prices, you should just be thankful you're not in Canada, right? Because Canada real estate prices have, literally like quadrupled in 10 years more. And if you're in an economy where nothing makes money, but housing is shooting through the roof, what do you put your money in? Housing, right? And so much so that 40% of Canadians, right, have either a small or a large chunk of their savings, like their retirement savings, in real estate trusts, right? Or real estate investment companies, right? Real estate funds. Because real estate was the only thing making any money on paper, right? The only thing going up in the Canadian stock market was real estate funds, because the only thing going up in Canada was real estate. And they have a real problem. Well, you can tell that they have a real problem because the 5 biggest real estate investment funds over the last 2 years have all suspended redemptions, right? So a fund suspending redemptions is like your bank account suspending withdrawals. It's not a good sign, right? They're basically saying investors can't take their money out. So now that 40% of Canadians that have most of it not even to their knowledge, right? There's a whole bunch of these bullshit money market funds like these BlackRock ETFs and dumb shit like that, and basically automated 401k investment machines, right? Because that's really what it is. Like if you have BlackRock or Vanguard manage your 401k, your retirement savings, it's just a really retarded, and I mean this literally, right? Compared to like what a lot of the hedge fund guys are running, the algorithm that decides what stocks your 401k buys has literal Down syndrome, right? It's the most unintelligent, robot ever. And it just basically throws you into whatever is moving or whatever is, anyways, it's dumb. So most Canadians probably don't even know that their money is in these real estate funds. So they don't know that their money is locked in them, right? The algorithm can't trade out of them because they can't get their money out. But, unless you are like hawk-eyed on your 401k, you're not going to know this is an issue, right? Mostly it's the individual private investors that are screaming about it. So they built a fuck ton of housing because it was making a lot of money, right? A literal garage in Vancouver or Toronto a literal 1-bedroom garage, not even like a fucking condo, a garage that has been turned into a garage, or sorry, turned from a garage into a tiny home, will cost you almost $1 million. So everyone obviously was in the garage building business. Like, you're going to pay $1 million for a shack? Okay. And a Canadian may not live in a shack, but 5 Indians will. So they had plenty of people to sell them to, which all sounds just shitty, but fine. Except for the fact that in Canada, and as an American, we are going to find this incredibly unjust, because like we have a concept of like, if you make a deal with somebody, you make a deal, right? And the terms that you agree upon are the terms. But in Canada, that's not the case. So if you have a mortgage, a fixed rate mortgage is something that doesn't exist in Canada, right? It is an adjustable rate mortgage that you have to renegotiate every 3 years, from what I understand. And that means if interest rates go up, when you go to renegotiate that mortgage rate, your payment, it's the same exact thing that blew up the housing market in 2008, right? Those adjustable rate mortgages. Because for the last 30 years of them dishing out these mortgages, the interest rate hasn't moved more than like 1% up and down in either direction, right? Maybe like half a point, a quarter of a point. But in the last 5 years, especially the last 3 years, interest rates have gone up a hell of a lot more. And I'll talk about that last, right? Well, 60% of those mortgages are going to renegotiate this year. And if anyone's been checking what has been happening in the Anglosphere, right, as the Fed raises interest rates slightly, right? This is to your point about the world catching a cold, right? Let's take it, the Bank of Canada. I'm now going to be specific because I don't want to piss off any Canadians. Okay. Yeah, bond yields. Let's say the 5-year government bond. All right, let me see. Oh. Yeah. So across the Anglosphere, interest rates on government debt, which is basically where your interest rate from your mortgage is calculated, has been on a tear lately. And here I will take a little screenshot, and then we can look at this chart together. All right, so mortgages are basically calculated off, I believe, I don't know if it is because in the US, mortgages are calculated off the 5-year and the 10-year. But I think Canada is roughly similar. It's calculated on the 10-year and the 30-year. I think with Canada, it's the same thing. But the interest rates across the Anglosphere are just stacking up very, very quickly. And for like a government bond to move 0.25%, right, 0.1% in yield, right? So interest rate, basically, right? So the interest rate that the government pays on its debt, if you're a bond holder, right, that is yield to you. So in February 2025, the interest rate on government bonds in Canada, right, on the 10-year, was 2.9%. It's now up a point in a year, which is a very, very, very big deal. And it's projected to go up another point by the end of this year. All right, so 2% on government debt is going to basically shake out to like a 4% at the time that it shakes out at. I mean, what is a mortgage rate right now? 7%?
Yeah, it's pretty punishing. But I mean, in Stormy,
the Fed rate's only 4.25%. So that extra 2 points comes from the banks off of the government interest rate. So if the government interest rate goes up 2%, when they go to negotiate that mortgage at the end of this year, 60% of them, it's going to be 3 or 4% higher than whatever it is they're paying now. And in mortgage terms, 4%. I mean, to give you an example, I was looking to buy a house in 2021, and I knew the stock market was going to crash. And I knew that every time the stock market crashes, the Fed drops interest rates to basically zero. So I'm like, all right, cool. All the people buying houses are buying them in cash, but basically cash that's borrowed against their stock portfolio. Stock portfolio gets, a 30% haircut. Nobody will be buying houses for cash anymore, which was correct. What I didn't see is the Fed, for the first time in history, raising interest rates into a stock market crash. So I was looking at, I think the home I was looking at was $1.75 million. And the mortgage payment on the amount I was going to finance was roughly like $4,000 a month. The interest rate going up, the Fed interest rate going up 1.75 points, made the mortgage rate go up 2.9 points. And that 2.9 point difference turned a $4,000 payment into a $8,500 payment. Right? Same amount borrowed, same term, 2% increase. The payment doubles. So the people in Canada, 60% of them, are going to have their mortgage payments double. And this is why the real estate funds are freezing redemptions. Because another scary thing is that Canada doesn't do GIBs like we do GIBs. Canada just puts them on the payroll. So some retarded number, like almost 40% of Canadians, are employed by the federal government, like their government, right? So rather than just hand them free money, they just hand them bullshit jobs. So if you're a government employee, you're kind of on a fixed salary. So if your mortgage payment doubles, you're going to lose your fucking house. That's all I wanted to say. And if, a third of your economy is real estate speculation, that's going to be really bad for you. Or sorry, for your economy. Like, Canada is going to get a 2008, but only after it restructured its entire economy around housing. So 2008 is bad, but the US did not structure its entire economy around housing before the crash. Canada has restructured its entire economy around real estate, and it's going to have a real estate blow up. It's going to be really bad.
So before we went live, so to speak, you mentioned that one of the things you really want to do is not simply offer analysis, right? Offer some sort of, viable alternative or viable path. And I realize you've painted quite a grim picture here. So, to be honest, like, what should people do?
Okay, so the only time you can really make, if everything is going according to plan, no one can make any money, right? So like if the stock market is just steadily crawling up every single quarter, just up and up and up, and you're on the bottom of the ladder, you're never going to be able to climb that ladder because everybody else is also, all the people above you are also, moving on up faster because they have more money compounding, right? The only way a person can move up in the economy is when other people fall down. So we're talking about something that is ostensibly very scary, but it is also a chance for people to move themselves up, right? So they price options. All right, how much an option costs is a function of how much volatility is. And if volatility is very, very high, right, the cost of that option is going to be equally high, right? Because they're pricing the chance of, the asset swinging in either direction very aggressively, right? They're trying to cover their ass. So with people, right, that volatility is where you make money. You can't make any money if everything goes according to plan. You need volatility. If there is no volatility, then there's no gains to be had, right? When everything goes, so how people should see this is, imagine if you knew that certain parts of the economy are going to be really bad for people that have their money in certain things, or how they position themselves right? Because what's a good way of putting it? I'm trying to think, because there's a lot of people that just straight up don't have any assets at all, right? But if you have some assets, and I'll probably get a lot of criticism for this, but I hold a lot of Bitcoin. And everyone is like, oh, well, Bitcoin went down a whole bunch. Like it always does, but it provides me liquidity, right? And it basically runs in much of the same mechanisms, minus the volatility as gold and silver does, but it allows a lot faster liquidity, right? This is why JP Morgan is allocating a lot of money to crypto, specifically Bitcoin, not, Ethereum or whatever. Fidelity has been doing the same thing, right? They bought all the way down, right? And in any type of really inflationary environment, you're going to see things that have liquidity and store of value become everyone's favorite assets. So how do you deal with a inflationary environment? You buy assets. Okay, what else can you buy? You buy commodities, right? And the commodity cycle is just now starting. Land is a commodity, especially agricultural land is a commodity. And it's one of the things that our economy has grossly underpriced for a tremendous amount of time. All right. You don't actually have to go plant crops. You can literally just lease the land out to farmers, right? So the income generation is kind of like sticking a renter somewhere, Like you were talking about, like, oh, well, even if, no matter what happens to rents, there's somebody behind that renter has to be paying that mortgage, right? So land is something that is infinitely more liquid than gold is without the haircut, right? It's different than housing. People should recognize that. Commodities, if you want something that is publicly traded, that you can slide into and out of, right? Turn to money very, very quickly. People need to focus heavily on commodities because you're basically facing a once in an 80-year commodity super cycle. Right? And that's a whole separate podcast, but there's specific types of assets where a lot of this stuff will pass you by and that have been grossly underpriced. Because the thing that we've had in this hyperinflationary environment is a tremendous amount of capital concentration, right? Not only is there a metric fuck ton of money, but the metric fuck ton of money is all concentrated in very specific things, right? Which, in my opinion, is very, very dumb things, right? And it seems that the market's kind of thinking it's dumb too, which is nice, because software companies are basically falling apart right now as far as the stocks. And you're seeing all of that money have to go into things like small caps, into commodities, right? So as money bleeds out of these balloon industries, these balloon sectors, it's going to reprice a lot of other things. But basically getting yourself on the ladder board should be the most important thing, whether it is assets in public markets, whether it is real estate in terms of land. I wouldn't want to be flipping homes right now, right? But land is also something that people can afford, right? It's not something that they're priced out of, right? Land is infinitely cheaper than the house that you put on it. But now nobody wants that house. So for people with no money, they need to be skill stacking. I mean, I'd almost have to really think about it for like some time to basically tell the person without any money, how they need to position themselves. But for a person with even a small amount of money, you have a chance to get it right in a way that will not necessarily set you up, but put you on a ladder where you otherwise wouldn't. Like a good example of this would be like after 2008, I was sitting at my kitchen table with my dad. I had just gotten out of college. And like this was like 2009. So the crash was like in full swing. And my dad is sitting there and he's like, if you had an extra $100,000, right, sitting around, like, would you buy GM, Ford, and Bank of America? And I mean, these stocks were, I think Bank of America was, I always get it wrong, but these stocks were dollar, like single digit and low double digits. Like, I mean, it looked like they were going to go bankrupt, right? Nobody knew. And there was a series of 3 or 4 stocks my dad asked me about. And I basically pussied out. I said like, oh no, like, I did the typical doomer take. I was like, oh no, we just saw Bear Stearns go bankrupt. There's a good chance Bank of America could go bankrupt. Ford and GM, it kind of looks like it's over for Ford, and it really looks like it's over for GM. And there was one other stock, I can't remember what it was. But if I had told him to buy those stocks, I can't remember. I did the math once, and it would have been something like $15 million. right? So in a crash, you have a chance to buy things at fire sale prices, right? Basically, a whole bunch of investment bankers, fell off the ladder. And all of a sudden, all of these rungs opened up. A lot of people made a lot of money coming out of the great financial crisis that never would have been able to make any money if anything had just gone on the way things always go. And people should look at if you're not on top, a crash is the best thing that can happen to you. Right? I mean, inflation's going to suck, but there's ways of mitigating inflation. I'll let people, research various ways to basically, I can't help you make groceries cheaper, but if you've got a couple $100,000 that you're trying to keep away from inflation, there's a ton of ways to do that. But people should look at this like an opportunity, because it's only when things get shaken up really, really hard that there's a chance to make moves. When everything just goes on accordingly, the big things just get bigger and the rich people just get richer. But when the rich people lose their shirts, there's a chance for you to actually make money. I made most of my initial nut in housing during the foreclosure crisis. I used that to fund my first startup. If it wasn't for the 2008 financial crisis, I would probably be, working in some cubicle somewhere. So it was actually the 2008 financial crisis that gave me an opportunity to make a bunch of money, because a whole bunch of banks lost their shirt. So that's the way. It's really just mindset.
I think that's the closest that you and I have ever gotten to a hopeful message in one of these episodes.
Right? I think that's a win. It was all over the place, but yeah, trying to discuss the economics of this country right now isn't fun. Same thing with all these people losing their jobs. There's mass amounts of people are very upset about layoffs. And I think a lot of the people that have gotten laid off, I mean, especially if you work in tech, you're like, the outsourcing is going to come to an end very quickly, because, and a lot of people are factoring this in, but like, there's also going to be a lot of data breaches, because an Indian in Calcutta, right, he doesn't know that, an admin, he doesn't know the importance of like admin access. So if his cousin wants to give him $1,000 US for admin access to like all of the bank accounts at XYZ bank that just outsourced to India, right? Like, this is going to be a disaster for a lot of these companies, right? And they're going to, especially all the AI and tech companies, are going to have to end up bringing it all the way back home, right? So this outsourcing thing is just really lame corporate problem solving that's going to get unwound. But I bet a lot of the people, it may not seem this way now, but if you were some corporate drone at Facebook or, Deloitte or whatever, I bet you if I ask you in 10 years from now, are you happy you got laid off? You'll probably tell me yes. Because everybody in our sphere jokes about all, these bullshit jobs, how most of the jobs are bullshit jobs. Well, they're bullshit jobs that will literally suck your life away from you. And you'll be an old man before you know it. Right? But you'd probably be too scared to basically try and do something else. So I think a lot of people are going to, by circumstances that are out of their control, be forced to do something they otherwise wouldn't have. That seems impossible and scary. But they'll come out the other end very glad they did it. Like, are you going to be glad that you didn't spend 10 more years in some soul-sucking corporate hellhole with some screaming HR manager? I think we're going to see an explosion in entrepreneurism. I really do. Because it's the only way people are going to be able to guarantee a lot of income security is if they manage their income themselves. And I think it's going to be great. And I think a lot of people are going to be a lot happier.
Well, Stormy,
So just be glad you got fired, I guess. even though it doesn't seem that way.
that's what I said.
Are you happy? Hey, you're actually a perfect example. Are you
yeah,
happy?
are you kidding? I was horrible at having real jobs. As as anyone who worked with me could confirm.
Would you have ever done what you're doing now?
Decent chance, but no, to be perfectly honest. It was a decision
if I had
made for
caught
me.
up with you and been like, hey, do you want to just go and be a content creator on the internet? You'd be like, fuck no, dude, I have bills to pay.
You say that hypothetically, like you didn't tell me to do that.
Well, so I told you to do it when you were doing something. You were not working a corporate job all the way yet. You were already halfway out the door, and you were already making at least some money off of this. It was you had significantly de-risked my investment analysis. You took all the risk off of it. But I mean, are you happier?
Oh yeah, are you kidding? Even aside from, okay, yeah, sure. Like I have a job that's not particularly like hard or backbreaking. Like it's not like I'm doing something physically strenuous. But being unemployed is great. Or being self-employed is great. I could never go back, genuinely, for any number.
I was listening to your talk with Lucas, and I think there's a lot of people that would be very, very scared, too scared to do something like what Lucas has done, but would always in the back of their head wish that they did. And I think a lot of people are going to find themselves where doing what Lucas did is going to be the most sane choice you have. And I think a lot of people are going to be good at something they never thought that they were going to be good at, and be very, very interested in something that they never thought they would have been interested in. Most entrepreneurs I know that, the business that they own now looks nothing like the business that they started or that they set out to make. So I think a whole bunch of people are going to be doing things that they didn't think they were going to be doing, and they're going to be much happier. So I think everyone being forced out or checking out of corporate America may be the best thing that ever happens to us, both politically and economically. It'll be, whatever comes out of this will be infinitely more resilient.
So Stormy, where can people find you?
I think just the Inquisition podcast, man.
Yeah, I'll be sure to link that as well as your Twitter.
Yeah. Give Jay Burden money. Prove my hypothesis correct.
Yeah, this is the best. This is the best shilling segment I've ever had. Yes, give me money.
Right? Give him more than a little bit, not a lot, but just more than a little bit.
Yeah, so I stop calling you for financial advice 2 times a week.
I doubt that will happen.
Well, dude, this is a ton of fun, man. I appreciate it. I'll see you on again soon.
All right, man. Later.